This recording is on Chapter 15 and the start of Chapter 15, and I'm going to discuss accrued accounting, the matching principle, and how to calculate accrued expenses. Now, accrual accounting means that every transaction is recorded as and when the transaction happens, regardless as to when the money is paid or received, which is different to cash accounting. Cash accounting is a system that we don't actually learn about in this particular unit. Cash accounting, you record the transaction only when the cash changes hands. In other words, when the cash goes in your bank or the cash comes out of your bank. We do accrued accounting, whereby the transaction is recorded as and when it happens. This ensures that we can adhere to the matching principle. Now, the matching principle just states that when an expense is incurred, it's got to match that financial year. So, for example, if we purchase a motor vehicle on credit and we purchase that motor vehicle on the 15th of May, but we only pay for the motor vehicle on the 15th of June, we purchased it in May. So it has to be recorded in May rather than when we actually pay for it in June. That is known as the matching principle. We have to match the revenue that we earn and the expenses to the year that they are actually incurred. You also need to understand at this point that all our revenue and expense accounts are closed off to the profit and loss accounts at the end of every financial year. This is done so that we can calculate either the net profit or the net loss. So on balance day, there are a few things that need to be done. One of these things are balance day adjustments. Now, balance day adjustments are just making sure that everything is recorded in the year that it actually happens. So first of all, we're going to look at accrued expenses. Now, the true definition of accrued expenses, and I'm going to type it up here, is an expense that has been incurred but not yet paid. So it's something that has happened. We have incurred the expense, but we haven't yet paid for it. And a common example of this is wages. So in your books, I'm on page 74, and we're looking at the example Joey's joint accrued wages. So wages for Joey's joint was $10,000 per week, i.e. $2,000 per day for a Monday to Friday working week, and are paid each Friday. Wages this year to date are $510,000. So into the wages account, I'm going to put a balance of $510,000. Okay. Assume that the end of the accounting period falls on the 30th of June and it's on a Wednesday, and employees have worked 3 days since having been paid the previous week. That means if they've worked 3 days, they've earned $2,000 on Monday, $2,000 on Tuesday, and $2,000 on Wednesday. That means into our wages account, we're going to put $2,000. But we haven't actually paid, sorry, I beg your pardon, we're going to put $6,000. Okay, for 3 days, $2,000 per day. But we haven't actually paid them for that $6,000. We only pay them on Friday when we pay $10,000 for all 5 days, including the 3 days that we're talking about now. So we've got to record the $6,000 into the wages account, and we open up a new account you've never heard of yet, and this is a liability account called accrued expenses. The reason why it's a liability account is because on Friday we are going to pay this money. So it's a liability. We owe this money until Friday. So we're going to put $6,000 in that account. So we need to go to the wages account, and on the debit side, we are going to put $6,000. Okay, the name of the account on the other side of the equation is accrued expenses, or your accrued expenses current liability account. We're now going to go into the accrued expenses account, and on the credit side, we're going to put $6,000. Of course, the name of the account on the other side of the equation is wages. We're going to put in wages. Now, you also know that on the last day of the financial year, we close off all our expense accounts to the profit and loss accounts. Please bear in mind, if you're following in the book, this section here, the book does not put in Okay, I am putting it in so that I can show you exactly how it works. So we've come across, also on the 30th of June, we need to close off this wages account. So we know that this wages account has $516,000 in it. We need to close that $516,000 from the wages account to the profit and loss account. So into the profit and loss account, we are going to put $516,000. Okay. So the reason why it is on the debit side is because it's coming out of the wages account on the credit side. So wages is $516,000 on the credit side. The name of the account on the other side of the equation as to where this $516,000 has gone is into the profit and loss account. Do you all agree with me? This account is now zero. And here we need to say that this amount has come from the wages expense account. But now the balance day adjustments are all done. The 30th of the 6th ticks over to the 1st of the 7th. Now the 1st of the 7th comes along, and we know that Thursday would be the 1st and Friday would be the 2nd. And on the Friday, we are going to pay out in our wages $10,000. Okay, so our wages expense would look like it was $10,000, but that's not true. Of that $10,000, $6,000 was for last year. So we've got to reflect that in our wages expense account. That's why on the first of every month, or first of every new year, we reverse the accrual expense account. So when you reverse an account, you take the amount out of the account by putting it on the debit side. That's why we've got accrued expenses are going to be $6,000. And where is the amount going? It's going into the wages account on the debit side. So let's post it on the first day of the financial year. In other words, on the 1st of the 7th, we are going to put $6,000 where? Into the wages account. We're going to go into the wages account, and like this says here on the credit side, on the 1st of the 7th, we are going to put $6,000 into the wages account. The name of the account on the other side of the transaction that's being affected by this is accrued expenses. So now our accrued expenses, our liability account, you can see has now been balanced. It is reduced to zero. We also have an instance here where our wages expense account has a credit balance of $6,000. So when we go to, and this isn't in your book either, the 2nd of the 7th, and we pay our wages. So wages is going to be paid in the amount of $1,000. And this is coming out of the bank, $10,000. Okay. And your narration is going to be weekly wages paid. And we're going to go and post that to our ledger. So we go into the wages and we put here bank, and the amount is going to be $10,000. Obviously, you would also have a bank account, and the bank account on the credit side, you would put $10,000. But we're just doing an extract here, hence you are only seeing this wage expense account. So now, if I was to balance this account off now for the new financial year, we would have $10,000 on that side, and we would want $10,000 on that side. And the balance that we are going to carry down is obviously $4,000, which is 10,000 minus 6,000. So can you see that is correct? Our balance of the wages account for the new year, in other words, the 1st of the 7th, is $4,000. And that's perfectly correct because of the $10,000, $6,000 had to be recorded in the previous financial year. And we've done that. We have recorded it in the previous financial year. So when it comes to the recording of the wage expense and the accrued expense, we need to bring in both our income statement and our balance sheet. And by now, you are used to seeing extracts of these accounts. Where does the wages expense go? Well, it goes into the income statement or the profit and loss account. And there it is there, where we say less operating expenses, wages. But the accrued expense doesn't go on the profit and loss account. The accrued expense goes on the balance sheet. Now, the reason why it goes on the balance sheet is because it is a current liability. So we would put accrued wages, we would put wages as 6,000, and on our balance sheet, we would put accrued expenses also as 6,000, going under the section of current liabilities. You are now ready to complete self-test exercise 1 on page 75.